The S&P 500 will close out the year at a new record high. That's according to Wall Street's biggest bull. It's John Stoltzfus of Oppenheimer. He's boosting his year-end target for the benchmark index to 7,100, citing progress on trade negotiations, removing lingering uncertainty for investors. Joining us now, the man behind that call, John Stoltzfus, Oppenheimer Chief Market Strategist. John, it's great to see you.
Julie, great to be on the show.
So
always great to be working with you.
Oh, I appreciate that. So tell me what was behind this change here. It seems like it was really driven by what seems like the avoidance of that worst case trade scenario.
Yes, indeed, that was it, because we came into this year with the 7,100 target. We maintained that through the beginning of the decline in February 19th. It started on February 19th. It had been a peak. Market was moving lower. Market corrected. We held on to that. But when the tariffs on April 2nd came out, exceptionally high, certainly beyond our expectations and most people on the street, we thought the tariff risk is great. We cut our target to 59.50. Looking still from where the market had fallen to eventually by April 8th, about 17% upside, I think, maybe even 20% upside from that point. And we've seen it. So we thought at this point, bring back 7,100. Fundamentals are improving. Look at the GDP print today. It ain't perfect, but it's certainly a lot better than the crew that was thinking we were going into a recession was thinking. And in addition to that, you've got earnings expectations not only meeting, but beyond expectations, another quarter so far. And all in all, the consumer's still shopping, and it's really, we'll have to see what the Fed does this week and look at the jobs numbers. But overall, as Larry David would say, pretty good.
Nice. But John, I do want to dig into the tariffs a little bit here because, you have the announcement that, yes, India is going to be at 25%. The Yale Budget Lab looking at the overall tariff rate of 18.2% is the effective tariff rate. So maybe not the worst, but not nothing either, and not the best case scenario perhaps either. And the markets, as you know, have largely shrugged that off. There are companies, though, this earnings season that are saying it is having a negative effect. So how do you factor that in?
Well, we would say it certainly really depends upon the companies. It not only depends upon the sector, but within the particular companies within it, who can do workarounds, who is really not affected, who has already diversified their supply chain enough to enable greater workarounds. And that's what we believe will help work around it. Also, if I'm correct, the Yale lab also looked at it, I think was looking at the overall effect of it. Wasn't it something like a cost of 1.8%, which still came out to, I think it was about $1,400 or $2,400 additional cost to most consumers. Because you've got to figure with the tariffs, the importers will eat some, the exporters will eat some, and the ultimate buyer will eat some. So if you split that into threes, it certainly looks better than some of the inflation we've seen over the course of the last 4 years that the Fed had to battle from March 22 until just recently. Well, not too bad, The other thing is, Julie, I've got to say, I think when we look at this, I think the whole tariff regime business is simply to lead to a fairer landscape for the U.S. in terms of competing. We gave away our manufacturing. We did it ourselves for years, okay? And now we realize since the pandemic, we've got to have some manufacturing back here, even if it's only in chips that are directly related to national defense or healthcare products that we were in short supply of during the pandemic when we realized that most of our drugs were sourced from China. So we look at it, we think it's diversification, global supply chain, and we think the tariffs are an interim policy. And this is not political. It is simply from a strategist point of view, what's the art of the deal here, And we think it's get everybody's attention. Deals so far, as sketchy as they may be, sketchy is the wrong word. As sketched out as they may be.
I think sketchy's the right word. Not fleshed out, not fleshed out. Fine, but John,
we'll settle on that.
we could go. I think we could go down a deep rabbit hole of debating the effectiveness of the tariffs and whether they'll be permanent or not. I'm going to go in a little bit. We'll save that for another day. I'm going to go in a different direction. I want to ask you about a group that really hasn't been affected by tariffs that much so far, and that is large cap tech, right? Is it easier to be bullish because there is that group that is really accounting for a lot of the earnings growth and a substantial amount of the stock upside as well in this market?
I think it most certainly is. And, anytime that every so often we find the bear skeptics and naysayers will act as if we're going back to the slide rule or the abacus or abacus, whichever way you prefer to pronounce it. But the reality is we're all on the upgrade cycle when it comes to technology, whether we're a business or an individual, and it's global, and technology garners a lot of its revenue from outside of the U.S., where there isn't as much innovation, except perhaps coming out of China, plenty of innovation, but it's not always the greatest business partner. And so looking at this, we can't help but think tech will help us here immensely, but also tech will help the other 9 sectors, because tech is infotech and communications services, which is the streamers, the social media, and the search engines. When you look at it, it helps all sectors become more efficient. It helps the consumer effectively deal with the companies they buy from more efficiently. Just look at the most recent big sale day from one of the big box companies, and the other big box company competed against them and actually did a little bit better.
Right. Yeah. Finally, I do want to ask you about valuations, John, because as you say in your note, your new estimate for the S&P 500 implies the price to earnings ratio of 25.8, because the earnings estimate is 275 from you guys for the S&P 500. Now, one of your counterparts on the street who is much more bearish is Barry Bannister over at Stifel. And he submitted this chart for a recent chart book, which looks at the enterprise value to economic growth of the S&P 500. And by that metric, he says, we haven't seen this kind of overvaluation in the S&P since the dot-com bubble. How would you respond to that?
Gosh, do I remember the dot-com bubble? I was one of the other very well-known names on Wall Street that was right in the middle of all of that. And fortunately, at that time, I was working with international ADRs and ETFs, diversifying very much the typical international stuff out of Europe and at that time Latin America privatizations. So I didn't get caught up on it. But technology almost primitive compared to where it is today. It was companies dreaming of people getting 1 million eyeballs to their website. And in reality, it takes billions of eyeballs to get profitability and good cash flow. The main companies that are involved here are well established and with everybody on the upgrade cycle, whether we like it or not, and the changes that are watershed due to AI that are already being seen when individuals rewrite a wedding invitation, rewrite a resume, and corporations make plans either logistically or in designing. We don't think there's a comparison. And I've been in this business for 42 years. Every boom, bust, and recovery cycle since '83. So I've been, I know the markets can humble you, but I do think the biggest problem here with valuation, I would love a 16 multiple, but not with a crash, okay? But what happens is the demand for good stocks is greater than ever because people today are investing more like institutions for purposes like retirement, realizing in a mass way across generations, all the way up to including the baby boomers, who will likely live longer than their previous generations. Social Security is not going to be here for us the way it once was. It'll still exist, but the percentage of the retirement income that it will provide. So people are investing in stocks, dividend stocks, laddered portfolios of fixed income, and as a result of that, the price of quality investments is naturally higher. It's Ed Yardeni who has said many times, the economist, there's not quite 5,000 stocks to go into the Wilshire 5,000, or ones that really qualify for the Wilshire 5,000, because private equity has taken so many stocks out of the public markets.